It is January 2026, and while most traders are still watching interest rate expectations and stock earnings, a silent change inside the global shipping system has already cut off a major portion of physical silver supply from reaching Western markets. This was not announced in a press conference. There was no emergency headline. There was no government statement. It was a regulatory adjustment buried inside international shipping compliance rules that most investors don't even know exist. But the effect is massive because this single change has just isolated the London bullion market from a huge portion of global physical metal flows. Here's what happened. Over the past 6 weeks, major international shipping insurers updated their compliance requirements for bulk metal transport, specifically targeting shipments moving through high-risk geopolitical corridors. On paper, this looks like routine risk management. In reality, it means any cargo containing strategic materials like silver now requires enhanced certification, origin verification, and government export clearance before insurers will underwrite the shipment. And without insurance, no major shipping company will move the cargo. That instantly slows everything. Not by banning exports, but by turning what used to be routine shipments into regulatory bottlenecks that take weeks or months to clear. And this matters because most of the silver flowing into LBMA vaults does not come from the UK or Europe. It comes from Latin America, Central Asia, and parts of Africa. It crosses oceans. It crosses shipping routes that are now flagged as politically sensitive. Which means, suddenly, massive amounts of metal that were supposed to be moving into London are sitting in refineries, warehouses, and ports, waiting for paperwork that may never be approved in time. This is not theory. Refiners have already confirmed that delivery schedules into LBMA vault networks are being delayed indefinitely. And when LBMA stops receiving steady inflows, the entire Western pricing system starts to break. Because London is not just a storage hub, it is the settlement backbone of global bullion trading. Most paper contracts reference metal that is assumed to be available inside the London vault system. When that assumption becomes uncertain, confidence collapses. Now connect this to what's happening in Asia, because this is where the situation becomes dangerous for price stability. While Western shipping lanes are tightening, Asian buyers are securing supply through regional logistics corridors that are not subject to the same insurance constraints. Chinese refiners, Middle Eastern sovereign buyers, and Asian industrial users are locking in metal through bilateral agreements that bypass LBMA entirely. They are not waiting for London approval. They are not relying on Western vault systems. They are building parallel supply chains, which means silver is still moving globally, but it is no longer flowing into the Western pricing hub. That creates an artificial shortage exactly where prices are discovered. And when the price discovery center loses access to supply, paper pricing becomes fiction. Now look at the inventory data. LBMA vault holdings have been trending down for months, but the recent acceleration is not from investor demand. It is from lack of replenishment. Metal is leaving the vaults, but new metal is not arriving fast enough to replace it. And once vault turnover slows, market makers begin to restrict physical settlement options. That is when you start seeing longer delivery times, higher premiums, and more cash settlement pressure, which is exactly what is happening now. Banks are quietly discouraging physical delivery requests. ETFs are increasing unallocated metal exposure. Clearing members are offering cash incentives to roll contracts forward instead of taking bars, because the bars are not coming in. And here's the part. Nobody in mainstream finance is connecting yet. This shipping rule did not happen in isolation. It happened at the same time governments are tightening export controls on strategic minerals. At the same time, trade wars are escalating. And at the same time, industrial demand for silver is accelerating due to electrification and military procurement. So what looks like a technical logistics update is actually functioning as a de facto export restriction without any country having to formally announce one. No political backlash, no retaliation, just slow, quiet supply strangulation. And this is the perfect way to restrict strategic materials in modern trade systems. You don't ban them. You regulate the transport so heavily that only preferred buyers can move them efficiently. Now let's talk about why LBMA isolation is catastrophic for price control. London operates on the assumption that physical metal can be sourced to meet paper obligations when needed. That assumption allows enormous leverage in the futures and OTC markets. But if the vault system becomes supply constrained, the leverage ratio becomes dangerous. At that point, price is no longer governed by marginal trades. It is governed by who physically controls metal. And right now, physical control is shifting east and south, away from Western financial centers. Which means Western markets can no longer suppress price through derivatives alone because physical scarcity eventually overwhelms financial engineering. And we have seen this before. This is exactly what happened in energy markets when European gas contracts were still trading while physical pipelines were being cut. Prices exploded not because traders were emotional, but because physical delivery mechanisms failed. Silver is entering the same phase. Now consider industrial demand, because this is what makes the shortage permanent, not temporary. Have you ever wondered why silver, often called poor man's gold, might be on the verge of a historic price reset? It's not just about speculation, it's about a perfect storm brewing in the global supply chain, and it's happening right now. Let's start with industrial demand. Think about the pillars of our modern world: electric vehicles, solar panels, massive data centers, and even advanced defense electronics. What do they all have in common? They all require silver. And here's the kicker. For these high-load, high-reliability systems, there are no scalable substitutes. Researchers have been trying for years, but nothing comes close. This means industrial buyers aren't sensitive to price. They're sensitive to supply. They will pay whatever it takes to get the metal they need, because redesigning entire product lines would take years, not months. So, what happens when shortages appear? Normally, you'd expect demand to drop as prices rise. Not this time. With industrial demand locked in, the only way to resolve a shortage is through price escalation. The price has to go high enough to force financial holders, people who own silver as an investment, to sell their physical stockpiles. But there's a problem with that theory. Those stockpiles are already dangerously low. Silver ETFs have been bleeding metal for years. Governments sold off their strategic reserves decades ago. And the private vault holdings? They're concentrated in the hands of strong, long-term investors who aren't selling into the first sign of a rally. The system has no buffer, so when something disrupts the flow of new supply, there's nothing to cushion the blow. And that's why a price of $150 per ounce isn't just wild speculation. It's the potential price required to ration an essential commodity among desperate industrial and sovereign buyers. Now, let's connect this to the banking system, because this is where things get contagious. Bullion banks are the financial plumbing of the commodity markets. They're involved in financing, leasing metal, and complex derivative structures that all assume one thing: a steady, predictable flow of physical silver. When that flow gets disrupted, these banks face a double whammy of delivery risk and collateral risk. Imagine silver prices spike rapidly. Margin requirements on their derivative positions would surge overnight, draining liquidity from financial institutions that are already feeling the strain of rising interest rates and a volatile bond market. And unlike a stock market dip, a commodity spike hits a bank's balance sheet from both sides. It increases their liabilities and their funding needs at the exact same time. This is the recipe for hidden systemic stress. And what can central banks do? They can print money to stabilize banks, but they can't print silver. They can't solve a physical shortage with a digital currency. That means the price, and only the price, can do the balancing. This brings us to geopolitics. New shipping compliance rules aren't just about insurance policies, they are a tool of strategic pressure. Western insurers and logistics companies are increasingly aligning with their government's risk assessments. This creates automatic friction for cargo moving from what are considered politically sensitive regions. Meanwhile, cargo flowing through friendly aligned corridors moves freely. What's the practical effect? Physical silver is naturally being rerouted away from traditional Western vaulting systems, like those in London and New York. This isn't happening because of some official decree, but because of pure economics. Countries like China, Russia, and the Gulf states are offering state-backed insurance and government-to-government shipping guarantees, making their trade routes more reliable. Once these new supply chains are established, they don't just reverse overnight. It takes years to restructure global logistics. This means the isolation of the LBMA isn't a temporary disruption. It's a structural shift in who controls the world's bullion. And that shift permanently weakens Western control over price discovery, paving the way for higher volatility and a much higher price floor. Let's talk about the final trigger: investor psychology. For decades, institutional money has treated silver as a fringe, speculative asset, not a strategic one. Pension funds, insurance companies, and major asset managers have almost zero exposure. This massive underallocation is a coiled spring. When the recognition finally dawns that silver is a strategic commodity facing transport restrictions and competition from sovereign nations, the reallocation of capital will be violent. And here's the critical part. Unlike stocks or bonds, the physical silver market is tiny. It cannot absorb even small percentage shifts from institutional portfolios without the price going vertical. We're not talking about a smooth, gradual rise. We're talking about price gaps, where the market jumps from one level to another with no trades in between. Once that happens, algorithmic trading systems kick in, amplifying the move and creating those explosive vertical candles you see on charts. This isn't driven by retail buying. It's driven by a complete evaporation of liquidity. Now, picture what happens when the LBMA can no longer guarantee physical settlement for its contracts. Trust in the paper market evaporates. Participants will scramble to secure physical metal directly, demanding delivery in Asian or Middle Eastern vaults. This further drains liquidity from Western exchanges, further destabilizing prices in a self-reinforcing feedback loop. And the trigger for all of this wasn't wild speculation. It was a subtle change in shipping compliance rules. Investors need to understand that this isn't a policy mistake. It's a deliberate strategy. Restricting the flow of strategic materials through regulatory compliance is a quiet way to exert control without causing a major diplomatic incident. It avoids headlines and trade disputes, but it achieves the same goal: supply control. In a world of escalating geopolitical competition, controlling essential supplies is the ultimate form of leverage. Silver is no longer just a market asset. It has become a geopolitical tool. And when assets become geopolitical tools, their prices are no longer set by simple supply and demand. They are set by power dynamics. Project this forward. As shipping bottlenecks continue, Western manufacturers will face crippling uncertainty. Governments will be forced to step in, subsidizing domestic mining and recycling. But these projects take years to scale. In the short term, their only option is to build strategic stockpiles. And when governments stockpile, they remove metal from the market permanently, tightening supply even further. Commodity crises don't end quickly. They escalate until a substitute is found or diplomacy prevails. For silver, neither is on the horizon. So let's bring it all back. The most important word here isn't silver, it's isolated. The isolation of the LBMA means Western markets are losing their grip on global metal flows. When control is lost, pricing power is lost. We saw this playbook with energy, and now we are seeing it with metals. And silver, due to its industrial necessity and inflexible supply, is one of the first to react. It's moving before most investors even realize the rules of the game have changed. If you're waiting for confirmation in the mainstream headlines, you will miss the move. By the time it's obvious, the metal will have already been repriced. This is how major commodity regime shifts happen. They start quietly, then suddenly they become permanent. Right now, we are still in the quiet phase, but the disruption has already occurred. The shipping rules have already changed. The only thing left is for the price to catch up with reality. And when it does, it won't be a gentle rise. It will be a violent reset. Thanks for watching, and be sure to subscribe for more insights.